Welcome to the Messy City Podcast, where we talk with the people who design, plan, build, develop, or even just think about how to create beautiful, successful, and humane cities and towns. Let's learn from each other and create places we truly care about. Welcome back to the Messy City Podcast. This is Kevin Klinkenberg. On the podcast, we've talked a lot about the regulatory side of housing and the impacts on housing prices and affordability from zoning and land development regulations and everything else. We haven't talked too much about the financial side of things. A few weeks ago, I was fortunate to have Chuck Marone back on and discussing his really good book called Escaping the Housing Trap, which really dives into the history of the 30-year mortgage and financialization of housing. But after that conversation, it just kind of occurred to me, it would be really cool to have somebody on the show that's not an architect or an engineer talking about finance. So I'm very fortunate today to have Charlie Palillo join us, who's the Chief Market Strategist for Creative Planning. Charlie, thanks. I really appreciate you doing this.
Thanks, Kevin. Great to be with you.
Before we get into your discussion, Charlie has done a ton of work on housing affordability, and he's put together a lot of really interesting thoughts and information about why we are where we are and what could be done about it. And that's going to be the meat of what we do. But I do want to give you a chance to go ahead and give the commercial for creative planning and your YouTube channel and the things that you do.
Yeah, awesome. So creative planning, we're just a large independent wealth advisor, one of the largest in the country and based in Kansas. And what we do is just try to help individuals, businesses, retirees make better decisions with their money. And we do everything from investment management to estate planning to taxes, pretty much across the board. So we're really a holistic wealth manager across all 50 states and international as well.
Talk a little bit about the information you put out on a regular basis on YouTube.
Yeah, so we have a few different podcasts. The YouTube channel is Creative Planning, and you can find that on there. I do a week in charts, which is basically a summary of every week, what's going on in the financial markets, what's going on in the investment landscape, what's going on in the economy. And Peter Maluk and I, who's the CEO of Creative Planning, we do a podcast every 2 weeks called Signal or Noise, really trying to help investors separate what's important from what's not. And there's a lot of noise out there, Kevin, in the financial markets. If anyone who's read the daily news or watches CNBC, you see all different headlines, scary things that we try to decipher. Well, what is meaningful and what's not? And I could tell you pretty much 99% of the time, it's just noise. Every once in a while, you have a signal in there.
That's great. So I actually, this morning, I was reviewing a little bit of your most recent This Week in Charts. And I think we can kind of jump off there because you really started by talking about how we're in the most unaffordable housing market in history. And so I got connected to you because my friend Dennis Strait had a conversation with you about the impact of the financial markets on housing, which is something in the world of architecture and planning that we just don't talk about very much. I don't think in our world, we terribly understand things very much about that world. But you have spent a lot of time digging into what's going on with housing, just really looking at it from the market side. And I think I want to start there and talk about what you see going on, first of all, globally with the housing market, and why would you describe this as such a terrible housing market?
Yeah, well, first, it's important to just look back at history, Kevin, and think about housing and how it's progressed over, let's say, the last 100, 150 years. And if we go back, basically, in the past 100 years, it was only in the last 25 years or so that housing became viewed as a financial asset, as an investment, as something more than just a place to live, where it kept pace with inflation over time. And that was it. And all of that changed, Kevin, during the housing bubble of the early to mid 2000s, where we saw this rapid appreciation far in excess of the rate of inflation. And then people naturally started to think, well, maybe it's not just a home. Maybe this is an investment similar to the stock market. And maybe even better, people were saying, because it never goes down. They were saying things like that, not looking at the history because, of course, it had gone down in the past. But that changed people's view. And so you saw a lot of crazy things going on during that mania where people owning multiple homes, taking on excess leverage. We know, of course, about the subprime crisis, but that really changed the thinking in terms of housing because we had such a large deviation from inflation. And we had never seen that before. And I think it really is important for people to think about it, break it down. What should a house cost and why should it track inflation over time? And basically, it's very simple, right? What should a house cost? It should cost what it costs to build it. And that's reflected in the inflation rate. It should cost what the wages are for people who are working on the house to build it. Well, that's reflected in the inflation rate. And of course, it's reflected in the cost of the land, which goes up over time because we have inflation. We have the value of your dollar being depreciated, as we'll talk about probably in a little bit with the Federal Reserve and the Treasury's policy. So a few percent a year, Kevin, has been the appreciation in the housing market for 100 years until the housing bubble. And then we saw just this rapid, crazy amount of appreciation. There was a crash after that. And in the past few years, we've seen a second housing bubble into the U.S. where it's pushed up prices above the rate of inflation more than what we saw during the housing bubble of the mid-2000s.
And when you look at some of the numbers as they stand today, there's some really crazy, interesting stuff like how the average age of new home buyers has gone up. And I think the latest number I saw on the average age of all home buyers is now like about 62 or somewhere in that ballpark. Which is unbelievable and beyond historic norms. So how did we get here? How does that compare to maybe where things were before this change in mindset?
Yeah, so let's just take the last 10 years and just look at the median first-time home buyer, because a lot of this of what we're talking about today is a lack of affordability for people who haven't entered the housing market. Now, even if you do own a home, yes, it's gone up in value, but you've probably noticed that your property taxes have gone up, your insurance has gone up, your maintenance costs have gone up. So there's inflation embedded in that asset that people don't often talk about, but that's a reality as well. But mostly what we're talking about today, Kevin, is people who haven't bought that first home. And if you look at people under the age of 40, this has become the number one issue. There's nothing more important to them than a lack of affordability in the housing market. There's a number of different reasons for that. One, we view it as really the American dream, right? Owning that first home has become a landmark for a lot of people. And two, it's simply what we spend the most money on in America. If we look at CPI, which is the Consumer Price Index in the U.S., which looks at the rate of inflation, well, over a third of that is in housing. So most people, by far, their biggest expense is going to be that house payment. So when you make that extremely unaffordable, as the policies that we pursued, unfortunately, over the last decade have done, well, it causes a lot of problems. So looking at the numbers, a decade ago, the median age of a first-time home buyer was 31, and this year it's 40. So huge increase. That's a record high. That's not something, obviously, you want to see. And if you look at the percentage of first-time home buyers in the U.S., it's 21% of the market is first-time home buyers. It was 50% 15 years ago. So huge transformation. So you have to ask, well, why are people delaying the American dream? Is it because they want to? No, it's because if you look at all the surveys, it's more unaffordable than ever. And we can dig into a few of the numbers that illustrate that. But the two that I look at most closely are simply, what are people's incomes in the U.S.? So what is the median family income in the U.S.? It's about $79,000. And what is the income that you would need to afford the median priced home for sale in the U.S.? Looking at, let's say, a 30-year mortgage with 20% down, you would need $124,000 in income. So that's a 57% gap between the two. Needless to say, it's never been that high before in history. The second way I would look at it is simply, what would that monthly payment, if you included the mortgage payment, property taxes, insurance, as a percentage of your income, what would that look like today? And most people, Kevin, advise, well, don't go higher than about a third of your income. 25% is pretty good in terms of how do you budget, how do you plan, and what house can you afford. Today, let's assume that the median income went out and bought that median price home for sale, it would represent 48% of their income. So basically leaving nothing else, nothing for travel, nothing for entertainment, nothing for savings. Everything is going to that housing payment, assuming they could get the mortgage, with which they couldn't. So obviously that's an untenable situation. And that's what brought us to the situation today where people are delaying that first purchase of the home. And it's what I've called the least affordable housing market in history.
So one of the things, as I listen to people talk about the finance side of things and where we are today, the big discussion really revolves around mortgage rates. And obviously we had a time period or extended time period where we had very, very historically low mortgage rates. And one of the challenges, we have millions of people who are like me, where, I've got a mortgage at 2.75%. And we're not moving. We might like to have a bigger house, more space for the kids and everything else, but we're so locked in at such a low rate that going to a mortgage even at 6%, which again, historically 6% is not a high mortgage rate. I think the first house I bought was probably close to 8% in the 1990s. So a lot of the discussion is about, we got to get interest rates down. We got to get mortgage rates down. So sort of two things that have really taken the air out of the room the last, several months. One is we got to get mortgage rates down. The other is, well, we need to have 50-year mortgages so that people can lower their monthly costs. I wonder if you could talk about the challenges with both of those ideas or solutions.
Yeah. And listen, if you knew nothing about why the housing market is so inflated today, if you were sitting in a room thinking of ideas, you would say, well, we got to make that monthly payment more affordable. There's only a few ways to do that. One, you bring down prices, or two, you bring down mortgage rates. And as we'll probably talk about later, they say they want to make it more affordable, but they don't really want to bring down prices. So they're attacking the other side of it, just that monthly payment. And there's a few ways you could do that. One would be trying to push the interest rate on 30-year mortgages down. And the other way would be trying to create new products like a 50-year mortgage that would lengthen the life of the loan and potentially, I say potentially because we don't know what the interest rate would be on that product, but potentially push down that monthly payment a little bit where they would say, oh, now it's more affordable. A lot of problems, though, with that type of thinking, Kevin, right? First, you have to go back to, well, why are housing prices so divergent today from where they should be? And I say should be because over the long run, anything can happen in the short run, but in the long run, housing prices are going to regress to the point where people can afford them. They're going to be a certain multiple of people's incomes. And because that's the natural area, that's absent outside influence. So if there's no government involvement, there's no involvement from the Fed, and it's simply a free market based on supply and demand. Yeah, in the short run, people can get irrational, as we've seen in the stock market, as we've seen in housing bubbles, and they could drive prices up above their fair value. But in the long run, it's going to regress to what can people actually afford based on their income, and which means prices will come down if you let them now. And they're starting to in certain areas like Florida and Texas. We're starting to see declines in prices because of that lack of affordability, because demand's going down. So what you're saying essentially with trying to lower interest rates here and trying to create 50-year mortgages, you're saying, well, we need to increase demand. We need to have it be so that the person who can afford it, it's an easier monthly payment. So the lower monthly payment, they would be able to buy that house that they can't afford. What's the problem if you just take 2 seconds thinking about that? Well, creating more demand, artificial demand, what's it going to do to prices? It's going to drive them up. And how do we know that's going to be the case? Because that's exactly what happened in 2020 and 2021. And we should probably talk about that because that is the big reason why we are where we are today.
Well, let's do expand on that because that era, when we hit the COVID era right there with the shutdowns and the spending bills that happened immediately in concert with the shutdowns, that's when it seemed like a little bit of a nutty housing market went really crazy. So why did that happen? And what do you see as the sort of the fallout from that period?
Yeah. So already, if we go back to 2020, we go to pre-COVID and we look at affordability, we look at price appreciation compared to inflation, already we were at stretch levels. We weren't at the housing bubble levels of the mid 2000s, but we were in a pretty elevated place. Now, after COVID hits, we decide as a country, and we could talk about whether that was ultimately good or bad. There's still people debating that. We decided to put a Band-Aid on it. Essentially, we're going to borrow trillions of dollars. The Fed is going to print trillions of dollars to buy that debt. And we're going to send some of it out to people in the form of stimulus payments. We're going to send it to businesses. We're going to do a variety of different things. But we're essentially, Kevin, increasing the money supply in the U.S. by 40 to 50% in a 2-year period. And that's never happened before in the history of the United States. We've never seen such a rapid appreciation in terms of the money supply in the U.S. And we've never seen this broad stimulus being sent not to just people who lost their jobs and were in a tough place, to everyone, right? Retirees, people who were working, people who got raises, doesn't matter. Indiscriminately, we sent it to people. And that felt very good. It was a very, very popular policy at the time. All 3 rounds of stimulus, huge rates of support. You're talking about 70, 80%, according to the polls. People loved it. Why wouldn't they? You're getting a free check in the mail. You haven't lost your job. If you did lose your job, your unemployment was likely paying you more than when you were working, which was the first time in history we ever tried that. And so you had a combination of things that caused the supply of money to increase, people's wealth to increase, and naturally, part of that is going to go to spending. And part of that spending is not just on consumer goods, which drove up prices there, but it also went into the housing market, right? And so people had more money. They have more money to make a down payment, right? So some of that went into housing, make it more affordable. Now, at the same time, you had the Federal Reserve, Kevin, this is really where it gets interesting, in 2020, doing what they call quantitative easing. So essentially creating money out of thin air and going out and buying bonds, and not just treasury bonds. They went out and bought trillions of dollars of mortgage bonds to drive the interest rate on those things lower. So that's how you got your mortgage below 3% back then. Thank you, Federal Reserve, for buying trillions of dollars in mortgage bonds to push it down. So a very unnatural market, right? So we're so far away from a free market of just supply and demand right now. We're extremely manipulating the demand side. We're saying, here's all this money. Let's see what happens. Well, as it turns out, inflation is often caused by too much money chasing too few goods. And we didn't all of a sudden have more housing supply in the U.S., but we had all of a sudden way more demand because of all these reasons. So the Fed is buying trillions of dollars in mortgage bonds, driving that interest rate lower. Well, all of a sudden now you can afford 100,000, 200,000, 300,000 more in terms of their house. And people went out and did it, right? And naturally, home prices as a result went up. In a 5-year period, they went up about 50%, which was far in excess, of course, Kevin, and here's the problem, of what people's wages went up. So now you have the situation where people who haven't entered the market are stuck because they don't have that interest rate anymore and prices are up so much. And so now you have the aftermath of it, which we should probably talk about.
Yeah. And in that aftermath, I have a day job running a certain organization, but I also dabble a little bit in development on the side. And I've got a townhouse project here that's kind of plagued by it. So I'm like deep in this right now. We built, starting in 2022, I guess it was, about a $7 million project. We built about 10 townhomes that will for sale and 10 apartments for rent. And the apartments rented right up. The townhouses, by and large, are sitting there. And because in that era, we got hit by the construction inflation. And then by the time we came to market, we had the higher mortgage rates. And so you're in a situation where they're really made for a younger buyer, but a lot of the younger buyers are effectively priced out of buying it with the combination of the price and the interest rate that they'd likely be facing. And so it feels like, in a lot of ways, the housing market is just stuck. There's not much churn in it because people like me are not selling our houses, and the younger people are having a hard time getting into the market. So I guess the $1 million question is, how the heck do we get out of this?
Yeah. I have a number of ideas, and none of them are probably going to be popular. But before we talk about that, let's talk about, why we're in that situation. Sure. So what happened following the Fed doing all of that stimulus. Well, and the federal government, borrowing money and sending it out to people. Well, inflation did go up, right? We had 9% peak inflation back in 2022, and that was the highest we've seen since the early 1980s. That scared a lot of people. It scared the Federal Reserve. They started hiking interest rates, fastest interest rate hikes we've seen since the early 1980s. They pushed rates above 5% on the short end. And guess what? They stopped buying mortgage bonds and they stopped supporting that. And not only that, they let them start to roll off their balance sheet, which means when they came due, they just didn't reissue them. So slowly but surely, the Fed is coming out of the mortgage bond market, not supporting it. Well, what do you think happened to mortgage rates? They normalized. They went up to closer. I say closer because we're still far from a free market, but closer to where they would be absent this outside influence. Right. So they go up as high as 8%, depending on your credit score. Right now, they're around 6%. And so big difference, right? If you have a home price that's gone up 50% and you have a mortgage rate that's more than doubled compared to a few years ago, what's that going to do to affordability? It's going to absolutely crush it. It's going to absolutely crush it. So here's now the situation, what we're in today. Well, how do you solve it? Do you solve it by going back to what we did before? And that's what I'd say 90% of people are calling for, Kevin, is to simply, look, rates are too high. Let's just attack that problem. The Fed should cut interest rates. They have been cutting. They've already cut 1.5%. They're likely to continue to cut if you listen to most of their comments. And people are saying the Fed should go out again and start buying mortgage bonds, drive this thing down. And then you have the federal government saying recently, we need to issue a 50-year mortgage, right? Without thinking through again, well, wasn't that the exact cause of the problem in the first place? Right? If you artificially stimulate demand, it's going to drive up prices. And that's the part that I think is really missing.
Yeah. So let's get into some of your prescriptions because I think this is a fascinating list. And in my world, we mostly talk about a lot of wonky like zoning and land development regulation possibilities, building code things that we could do to help affordability. And I do think all those are really important. And as I mentioned to some friends the other day, we need to work on all those things. None of them are probably an immediate savior, but they would all help, especially with new construction and helping make new construction a little bit more affordable, especially at the smaller scale, say like 6-unit buildings and under. There's a whole lot we could do. But you also looked at this from the financial side, and you have a really interesting list, a list of things that I think, like you said, most of them have a constituency that would make them really unpopular. But I mean, that's the nature of things. So even a lot of the zoning changes we talked about are unpopular with a lot of people. So let's talk about what some of the things are that you see that really could impact and get us back to something closer to a free market.
Sure. Number one, just very simple. Stop printing money at the pace that we're printing it. And money supply continues to go up. It's not going up anywhere near what it did in 2020, 2021. But if you simply limited the growth of that, that's going to all else equal help in terms of inflation, in terms of housing inflation. So just don't do again, Kevin, what we did back then, please, right? Because then you're really going to have a crazy situation where prices are already at record levels, record unaffordability is going to get even worse. Number two, and I don't hear anybody talking about this in Congress, but why does the Fed have so much control over the housing market and the economy in general? So we don't ask the Federal Reserve how many bananas a supermarket could sell. We don't ask the Federal Reserve how many cars should General Motors or Ford produce. So why in the world are we entrusting them with figuring out the most important thing in an economy, which is the cost of money? Why are 10 people sitting in a room together smarter than the free market and saying, this is the interest rate where it should be in terms of this will create the maximum employment they talk about. So, anywhere from, let's say, 3 to 4% unemployment and low inflation. Now, they've screwed that up time and time again. So why do we still entrust them to figure that out? They have an incentive, Kevin, to err on the side of easing, err on the side of manipulating things. So I would take them out of that decision-making process. And then where would interest rates be? I don't know, but probably higher than where they are today. So it sounds counterintuitive because we're saying, well, wouldn't higher interest rates mean a higher monthly payment? Yes, but it would bring the price of that asset down, right? It would take out that artificial demand. And that probably won't be done, Kevin. There's no, there's a big kind of belief that we need this all knowing body called the Federal Reserve to figure out this interest rate. And if there's a crisis, we need them to step in and cut interest rates to zero. So there's a lot of people who are in favor of that. So I'm not suggesting that would be an easy thing. But what I do think can be an easy thing is simply say, do not allow the Federal Reserve to buy mortgage bonds. Like, do not let them do what they did back in 2020 and 2021, which is take a housing market that was already hot and essentially pour gasoline on that fire. Like, don't let them do that again. I don't see any rational reason why the Federal Reserve needs to be buying mortgage bonds to artificially push mortgage rates down when we have this affordability question. Maybe it would be a different situation, Kevin, if we were in, go back to the Great Depression, housing prices are depressed. There's deflation in the US. We're not in that situation today. So simply get the Federal Reserve out of things, control the level of money printing. That would be number one. And number two, in my view. Number three would be in terms of the Fannie Mae and Freddie Mac influence that continues to grow and grow and grow. And these are entities that simply, buy these mortgage pools, insure the mortgage pools that are existing today. So 70% of the mortgage market is now controlled by Fannie Mae and Freddie Mac. These are government-sponsored entities. They're not part of the government, but they really are part of the government. And if you get them out, once again, the interest rate on that mortgage is probably going to go up, but now you're not subsidizing it. So the price of the good is going to come down. And from there, Kevin, it's all the stuff that you're talking about. Dealing with supply. How do we create more supply in the U.S.? And there's many different ways, obviously, dealing with regulations and dealing with a lot of that's local. And, every state and every city and every community can try to figure that out. But the big macro issue is simply get the Federal Reserve, get the federal government out of the business of pushing up home prices to unaffordable levels. And you say, well, why wouldn't we want them involved in that? Because this is the problem we've created. So you have to start with the belief, Kevin, and this is a tough one for people, that it's not a good thing to have a housing bubble in the US. It's not good for the economy. It's not the same as seeing, let's say, your 401k or IRA and your stock market portfolio go up and earnings go up in corporate. It's not the same thing because the housing market is not an exportable good. It's not something that is going to create value. It's something that's going to depreciate over time. Anyone who owns a home knows that they're going to have to replace the roof. They're going to have to replace, the boiler. They're going to have to replace a million things. This is a depreciating asset you're trying to push up the price of. That's not a good thing because you're now delaying family formation in the U.S. We're seeing that with the younger generation. You're decreasing mobility. So you said, you're not likely to sell your home. Well, that's millions of other people are in that situation. They bought a starter home or they bought a home a few years ago. They have a low interest rate. Well, now they can't afford that new home because the mortgage rate is so much higher. And that creates a lack of mobility. And also in an economy, a dynamic economy, you want people to move to where the opportunity is, right? So if there are more jobs in Texas, in Florida versus New York and California, which has been the case, you've seen people move in that direction, right? You want that to be the case. You don't want people to be stuck in the house. So for all these reasons, as a nation, we shouldn't be promoting a housing bubble as a national policy. But for some reason, we lost our way and we kind of got into this game. Now, once we're in the game, it's very hard because of the vested interest to say, let's just let it go back to where it should be, which nobody knows, right? It should be at wherever the free market is. I'm not suggesting I know the exact level where mortgage rates should be or where home prices should be, but I know that it's an artificial market right now. It's not affordable and it's not based on supply and demand.
Yeah, and if I could go back to something you said early on, it's really what we've seen is the difference in attitude. Housing is like we want to encourage people to own homes, and owning a home is a good thing. And over time, especially if you can get to a place where you own your own home outright, that's a really good thing for people. And it does help with wealth building. But there's a difference between that and the idea that your house is an investment vehicle where the value is going to go up 10, 15, 20% a year every year, and you treat it like it's part of the stock market. And it seems like that's where we've really diverged. And somehow there's a lot of challenges with getting people back to a mindset where my house is a great place to live and I want to own it, but it's not something where I'm going to be, doing a cash out refinance every 3 years and taking, 50 grand out to go spend on whatever I want to do.
Yeah. Well, if you just break it down, unless you're selling your home, like the appreciation, it's great if people feel better. And certainly you want to rather be going up than down. But all of the other costs are going up because of it. So your house is worth more, but it's not really worth more. It's just that your dollar is worth less. So people have to think that through. So if you bought that house and you're going to live there for 30 years, it's great. Yeah, it's appreciated a lot in the last decade. That's awesome. But look at what your costs have done over the last decade in terms of maintaining that asset. So it's not the same as buying an S&P 500 index fund where there's no cost. You don't have to do anything. It just sits there, right? Over time, hopefully it'll be higher. Historically, it's grown about 10% per year. It's not the same as a house, right? Your house has all of these costs that go into it. And people always exclude that when they calculate they just say, well, I bought it for this and now it's worth this is what I could sell for. So that's the gain. Well, you forgot about all of those costs along the way. And so if you're not selling that asset, I'm not sure why you want to inflate it higher, because it's going to put pressure on you if your income isn't going up as much of the cost of that, all of that other stuff. And that's where we are today, Kevin. That's why this has become a national issue, this affordability issue. It's because people's income haven't kept pace with the appreciation in many different areas, the housing market being the biggest one of them. So really, it comes down to now, will the vested interest allow the free market to come back into the housing market, or are the vested interests going to push for doing more of the same?
It certainly seems in the short term, I think we know the answer to that. It's probably pushing for more of the same. But I'm also curious about like how you think about talking about, if we go back and think about the 30-year mortgage and the creation of it. We have a story around the 30-year mortgage in the United States that this is what saved us from the Great Depression, because the federal government stepped in first with, I think, 20-year mortgages and stabilized banks that were failing all over the country, and then eventually created the 30-year mortgage, which created this financial project that enabled mass home ownership in the United States, especially after World War II. And that's a story that I think all of us, I think it's like embedded within us as Americans. Like, this is a great thing. It's a wonderful thing we did. It was the right thing to do. It's done nothing but be a positive for the country. But it's also true, like you said, it's a massive manipulation of the housing market and finance. And so how do you think about talking about that issue in a way that helps people understand the consequences of those choices in the 1930s?
Yeah, it's just such a different world today. And so, like, something that was created to perhaps help or solve a problem back then. Again, we don't know what would have happened absent that.
Right.
So maybe things would have been just fine. You could never prove what the
Right.
counterfactual would have been.
Right.
But home prices compared to inflation were very depressed during the Great
Yeah.
Depression. They were going down more than prices were going down. So couldn't be more opposite situation than today. So saying like, oh, we created a 30-year back then, we should create a 50-year today. Totally different, because prices were very low back then. The markets were extremely depressed. The stock market was down over 80% at that point in time. It was the worst crash we've ever seen in the history of U.S. financial markets. You had home prices down 30, 40% in many areas. Totally different than today. And my view, Kevin, basically on loan products is, well, what would a bank actually lend to people? Like, absent the government, if the government isn't saying we're going to step in and support it, what would a bank actually lend to you? Would they lend to you at 50 years? No way. No. And if they did, it would be double-digit interest, right? The math wouldn't make sense. So to me, that for that reason alone, that product probably shouldn't exist. And then you dig into the 50-year mortgage and you look at it, and a lot of people just stay in a home for 10 years. Well, what type of equity are you going to be building over that 10-year period with a 50-year mortgage? You're talking about only 5%. 95% is going to interest. And if you compare the 50-year to the 30-year, over the life of the loan, you're paying double the amount of interest in terms of that 50-year versus the 30-year. So you have to really think that through. And that might work out, let's say. But if you're really young and you get that product, but if you're talking about now, the median age is 40 and they're taking on a 50-year loan, they could potentially pass away before they pay off this mortgage. So instead of leaving money to their heirs, they're going to potentially be leaving debt. There's so many issues with it, but the biggest issue that I have is simply it's not a natural product. It's not even the 30-year. If you didn't subsidize it, it would exist, but it would exist at a much higher rate. So where should it be? I don't know. Like, I'm more of the belief that people view housing debt as different than credit card debt, and it definitely is for many different reasons, but it's still debt. And you have to think about that over time. Is it better taking on that debt level versus what else you could do with that money? So there's a debate about that. And, I come down on, if you're a young person today, should you stretch and take on this huge amount of debt, or should you wait until that house is more affordable? I think almost always the answer is wait until the house is more affordable for you than to stretch and take on a massive amount of debt and have it be such a high percentage of your income. So I don't think it's good advice to people to say, stretch, take on this debt because home prices are going to continue to go up 10% per year forever. And so it doesn't matter, if you have a 50-year, it doesn't matter what the interest rate is. I think that's bad advice. If it's far cheaper for you to rent than it is to buy, which is the case in every single metro area in the US, then it probably makes sense for you to save, invest, and until that ratio that we talked about earlier, what percentage of your income becomes more manageable, let's say 25, 30%, then that's the time for you to buy. But there's a lot of pressures for people to say, no, just always, it's a good time to buy a home, even if it's unaffordable.
Yeah, and I think even if you look at your analysis that I saw this week about the 50-year mortgage and the actual monthly cost, the likely change in monthly cost, which I think to your point is probably a higher interest rate because it's a longer product, it's a more uncertain product. So you're maybe saving $100 a month off the mortgage, which is nothing. And honestly, and if you were looking at a tool that saved people $500-600 a month off where their mortgage might be today, that was a new tool, that could be really compelling for a lot of people. But $100 a month is barely going to move the needle.
Yeah, and you could come up with that tool very easily, right? The government could say, we're going to just give 3% mortgages to all new home buyers, right? But we talked about the problem with that is that would create a huge surge in demand. And it's also not fair then to the next group where you take away that policy and now they don't have it. And interest rates eventually, if you let them float, they're going to go up and they're going to have worsen that lock-in effect where people can't move because of the lack of force. So if you're going to do it, you have to commit to it. And you have to think about, well, what are the consequences going to be of that particular action? And so it's not as simple as saying, let's just figure out any way possible to lower that monthly payment because that's going to have spillover effects and it's going to do the opposite of what you intended it to do, which is to make housing more affordable.
As you look at the housing market, across the country, and obviously a lot of markets tend to be very localized, although finance is not necessarily localized. The supply and demand is very local. And so you already mentioned, prices are coming down in Florida, Texas. There's a few places where a whole lot of housing was built. Prices are coming down because of the lack of buyers. As you look ahead, sort of absent any major intervention in the markets, do you think about prices starting to normalize around the country or come down in more markets? Or how do you all look at that from a market forecasting standpoint?
Yeah, so Case-Shiller puts out this index of home prices. They have a 20-city index, and I track that every month and look at the data there on a year-over-year basis. Now, about half of them have shown price declines, which I think would surprise a lot of people because if you ask most people, they would say, no, my house is worth more than a year ago. So about half. My expectation that number is going to grow in the next few months. We're just seeing more inventory come onto the market in many different areas, and we're finally starting to see that lock-in effect ease a little bit. So after a certain point, Kevin, people can delay that move, but some people have to move now. They didn't have any kids. Now they have 3 kids. They have to move, or there's a job that they have to take in a different area. So we're seeing that slowly but surely ease, which means supply is slowly trending up. And now supply nationally is about back to 2019 levels, which we're still lower than average, but higher than before. So I don't know where that's going to go in the next year, but let's take the next 10 years. What would be a reasonable expectation absent any outside forces, manipulating the housing market again? My expectation would be that there's zero rate of appreciation adjusted for inflation. So if inflation is 2% per year, I think that it will be very hard for home prices to appreciate more than that in the next decade, because that just means we're going to go to places that we've never seen before, which is possible. But every time in the past, Kevin, we've seen huge appreciation above the rate of inflation, we've seen a mean reversion. This time, I can't think of a reason why this time should be different, because essentially people's incomes are going to grow a few percent per year. That part of the equation not likely to change. So as you have supply coming back into the market, slowly but surely, it's going to normalize. And it can normalize by going flat for 5 years, or it can normalize the way it did after the last housing bubble, where nationwide home prices declined about 25%. In many areas, they declined 50% or more. We saw that in Florida, in California, Las Vegas, Arizona. So really the hottest areas flipped and they went down significantly. So I'm not saying that is the way we have to get back to affordability. That's one possibility. The other possibility is just simply it takes time for the housing market to normalize, which I think would be more palatable to a lot of people. It's probably not ideal, because if you want to address the affordability issue, you'd rather get it affordable today rather than 5 or 10 years from now. But I think, and we could talk about this if you like, the vested interests are simply too big to allow for that reset to happen very quickly.
Yeah. Well, let's talk real quick about that, with how you see some of the vested interests and what the challenges are to allowing the market to normalize.
Yeah. So the two big ones, right? Just think about it. Over 60% of people are homeowners. Do they want to see the home price go down in price? No, of course not. So they're not going to be in favor of helping those other people who are not yet homeowners by having a lower price and letting it normalize, right? They're going to say, let's keep this game going for as long as I'm in the game. And then when I'm ready to sell, then after I sell, then you could let the prices fall. So it's just simply constituency, right? If you talk to the average politician and they look at their constituents, they're not yet. People are talking about affordability, but they don't want to get there the natural way, which is to allow prices to go down. They want to find other gimmicks, as we talked about. And two, the financial industry, right? If we look at banks and lending and, the government as well here, right? They own the mortgage market. Do they want to see prices go down and have a repeat potentially of what we saw during the financial crisis back in 2008? Not to say it's the same. We're definitely not seeing the same types of crazy lending that we saw back then in terms of the subprime market. But if prices were to go down nationally, Kevin, 20, 30%, now you have a big problem, right? Where many people are underwater. You're going to have a rise in defaults. And so for many different reasons, financial institutions aren't going to want that. The federal government obviously isn't going to want that, because they're going to have to do another massive bailout of Fannie Mae and Freddie Mac. And then we just have, looking at local governments, right? And just think about the way property taxes are calculated in most places. They're calculated based on home values. And so local governments have loved the appreciation in the past few years, because it strengthens their argument for higher property taxes, right? Your home is worth 50% more. Surely you can pay 50% more now in taxes. And so unless there's a cap on the appreciation, which in property taxes, which a number of areas have, and now more areas are starting to push for, well, that's just a natural force saying, let's prop this thing up. Let's keep inflation going up, because that helps us. And the Federal Reserve, we know the Federal Reserve, stated back in 2010, this was a famous op-ed by Ben Bernanke back then. We had never heard a Fed leader talk like this, but he actually wrote an op-ed in the newspaper saying, yes, the recession is over. So the financial crisis ended. The recession ended in the middle of 2009. And normally, Kevin, following the end of a financial crisis or the end of a recession, the Federal Reserve always in the past, every single time, would normalize policy, which means that they would raise interest rates, which back then were at zero. They would raise them gradually. They would raise them because we don't need that stimulus anymore. And they would also stop quantitative easing. Well, Ben Bernanke said, no, we're not going to do that this time around. We're going to keep interest rates at zero. And they ended up keeping them there for 7 years after the financial crisis, which we'd never seen anything like that before in history. And they continued to do quantitative easing, print money, buying bonds. So why did he say they did that? Well, he said the main reason is what they called the wealth effect. So his view was that if you drive up the asset prices of stocks, if you drive up the asset prices of homes, people are going to spend more. That's going to be a virtuous cycle where the economy then does better because there's more consumer spending, and that in turn will help the stock prices, and that will help people's wealth. That will help people spend more, and so on and so forth. So people love that idea, right? Of like, I don't care what the consequences of that action are going to be. Let's just do it. Let's just try it out. And they did it. And we know so all of these different vested interests, Kevin, are saying we don't want home prices to go down. And even if they go down, we don't want them to go down meaningful. So you put those two things together. They're saying we want things to be more affordable, but we don't want the easiest way for things to become more affordable to happen.
Yeah.
So very hard to have those two positions at the same time. And nobody calls the politicians out on that, where they're like, affordability, you want the housing more affordable. Well, what about letting prices fall? No, we can't have that. Let's figure out something else.
Yeah, it's very true. So the last thing I want to ask you about is, from a market standpoint, how do you think about demographic change and how that factors into especially the housing market? And I ask that because we had a very large age cohort, boomers, who have tremendous wealth right now, historically, compared to other generations, and really are driving the economy and certainly the housing market. And one thing that's different than, say, 2008 is now it's almost 20 years later, and that group, that age cohort, is 20 years older. And, the oldest boomers are about 80 years old. And, life happens, and they're going to start dying off in significant numbers. But they also own a lot of the houses, a lot of the really expensive houses in real estate. How do you see that kind of demographic change as you think about markets or forecasting markets?
Yeah, it's really been a huge transformation in terms of the wealth of the country. If we look in the past 30 years or so, people age 70 and over now control about a third of the wealth in the country. They're about 10% of the population. So it's a huge mismatch, right? And part of that is natural, right? You would say they should own more because they've had more time to compound and assets, but it's a huge spread, right? The older generation has never been wealthier relative to the younger generation than we've seen today. And part of that is they've benefited from this asset price inflation that we've talked about in the housing market. So it's just two generations are going to be at odds. And you're right, they eventually are going to die off. Their kids will inherit that. What does that do to the dynamics of the housing market? That's extremely complicated to kind of project out, right? Like, is that going to lead to more supply, all else equal? Yes, that should help prices come down, I think, all else equal. But you got so many different factors. It's hard for me to say, like, for sure, like, it's going to lead to one or the other. But you have a deficit, Kevin, in this house. There's an estimated deficit of in the country of 2 to 3 million single family homes. So we're far away from the point where we have just like a flood of supply and all this excess inventory. We're not there, right? If we look at the last 20 years in terms of the amount of building, in terms of new construction of homes versus the number of new families that were built in the last one, it's a huge mismatch. And it's hard to estimate that exactly, but it's at least a few million, according to most of the things that I've looked at. So that means that this isn't going to be solved overnight in terms of the supply issue. It's going to take time. Anything, in my view, to incentivize building would be a good thing, and reduce zoning regulations and all the rest of it. But again, you have competing interests. People who have a home don't necessarily want more supply in their area. They don't want more crowded. They don't want a lot of things. So it's an it's a challenging thing to try to address.
Well, it might be a fun future conversation. We could talk about some of the little tricks that we've learned that can add some of that supply without people necessarily objecting or noticing too much. But you're right; it's always a big concern. There's the NIMBY effect is pervasive and it's strong, and it's a big issue in local governance that prevents a lot of new supply coming on the market. Charlie, we've gone about an hour here. I really appreciate your time. I want to be mindful of your time. How would you suggest that people find you, or what's the best way for people to track you down to learn more about what you're doing?
Sure. The best way is I post all of my thoughts real time on X. I don't recommend people spending a ton of time on social media, but if you like charts, you like data, you like stuff like that, that's where I post a lot of stuff. I also have the weekly show we talked about, the Week in Charts, where you can find us on YouTube and Signal or Noise. And it's been awesome to be with you, Kevin. So I really enjoyed this conversation. To me, this is just a passion project for me to talk about this stuff. It's tangentially related to what I do on a daily basis, but I really believe that promoting affordability in a free market would help this country tremendously and help the younger generation that we're not really thinking about today.
Yeah, agree 100%. It's a major issue, and if we don't figure it out fairly quickly, it's going to bite us in a lot of unpredictable ways. So, Charlie Bolello, thanks so much for your time, and we'll talk to you later.
Thanks, Kevin.